For years, if you listened to the financial news, you probably heard that silver was just an industrial metal, a relic. Commentators told us precious metals were a thing of the past. Brokers might have even said that holding physical assets was pointless, maybe even irrational. Well, that entire narrative has been completely flipped on its head. Today, what we're seeing in the retail bullion market is something we haven't witnessed in modern history. And I'm not talking about the daily price swings. I'm talking about visible, undeniable stress across the entire physical distribution network. Let's look at the facts. As of January 19th, 2026, one of the biggest precious metals dealers in the United States, APMEX, has put a $500 minimum purchase on all online orders. Think about what that means. Small retail purchases, like a single tube of American Silver Eagles or 10 ounces of generic silver rounds, are now effectively locked out of normal retail access. You just can't buy them online from one of the largest dealers anymore. This isn't just a small policy change, it's a major signal. And it gets more serious. Just 4 days before that announcement, APMEX implemented a $10,000 minimum for buybacks. That means if you wanted to sell your silver back to them for cash, you'd have to bring in at least $10,000 worth of metal. These aren't just random policy adjustments. These are early warning signs of systemic operational stress. They are red flags telling us something is fundamentally breaking down. The entire network that connects miners, refiners, wholesalers, and retail dealers is being pushed way beyond its limits. According to a letter from the CEO of APMEX, the most recent week was the fourth highest in the company's entire history for the number of orders placed. They saw a 40% increase in orders in just 1 week. The systems we have, the infrastructure that was built for a world where silver was stable between $20 and $30 an ounce, are simply not equipped to handle this kind of pressure. And here is this, the most telling part. Even after they put that $10,000 buyback minimum in place, the volume of transactions remained at historically high levels. This is incredibly rare. We are witnessing a massive wave of buying and a massive wave of selling happening at the same time, all crashing into a distribution system that has a fixed limited capacity. It's like trying to funnel a tidal wave through a garden hose. So, that $500 minimum order, it's not about APMEX trying to make more money. It's an act of operational triage. It's a survival move. Every single order, no matter how big or small, requires administrative work, inventory allocation, careful packaging, and shipping logistics. When you're drowning in orders, those small, low-value transactions become a massive burden that can grind the whole operation to a halt. They had to cut them off just to keep their heads above water. You might think, well, APMEX has its own private mint. Doesn't that help? Their mint is responsible for about 90% of their own silver bars and rounds. That kind of vertical integration should protect them, right? Wrong. Even with their own mint, the pressure hasn't eased up. Reports indicate that their production is only running at about 50% capacity. And it's not because the mint can't make the bars and rounds fast enough. The bottleneck is further up the supply chain. They can't get enough refined silver blanks and feedstock to keep the mint running at full tilt. The refiners, the companies that produce the pure silver used by the mints, are running around the clock. But they are prioritizing their long-term industrial contracts. Those contracts are locked in. They have to be fulfilled first. This leaves the retail-focused mints, the ones that make the products you and I buy, scrambling for whatever supply is left. As a result, we're seeing pre-sale delivery times stretch out to 3, even 5 days or more. This isn't just a temporary backlog of orders. It's a sign of a deep structural bottleneck in the supply chain. Now, let's take a step back and think about the bigger picture. If a company as large, well-capitalized, and vertically integrated as APMEX is facing this level of strain, what does that mean for everyone else? What about the smaller regional retailers? The independent coin shops in your town? They are far more vulnerable. And we're already seeing the effects. Many of them have stopped taking new orders altogether. Some have taken down their public pricing, meaning you have to call just to get a quote. Others are restricting sales only to their existing longtime clients. The entire physical retail infrastructure is under immense pressure. It is buckling. And all of this is happening while silver is trading near $93 an ounce. The market is screaming that something is wrong. The days of dismissing silver are long gone. What we are witnessing is a fundamental shift, a powerful reminder that in times of uncertainty, the demand for real, physical assets can overwhelm the systems we once took for granted. The warning signs are flashing bright red. The question now is, are people paying attention? Thanks for watching. If you found this information valuable, please consider liking the video and subscribing to the channel for more updates on this developing situation. Stay informed and stay safe. Have you seen what's happening with silver? We're not just in a bull market anymore. This is something else entirely. In less than 3 weeks, silver skyrocketed from around $71 an ounce to a staggering $93. That's a jump of over 30%. This isn't a slow and steady climb. It feels more like a rapid remonetization event, and it's putting immense pressure on the entire market. This incredible acceleration has triggered two powerful waves of demand, and they're hitting at the same time. First, you have the industrial giants. Think about the sectors driving our future: solar power, electric vehicles, semiconductors, and those massive hyperscale data centers that power our digital world. These industries don't just pop down to the local coin shop. They have long-term contracts to buy silver directly from the refiners. This means huge quantities of silver are being locked up and taken off the market before you or I ever get a chance to see them. What's really fascinating is how modern technology, especially AI and data centers, is consuming silver. The metal is essential for their complex hardware. And once that silver is built into a server or a microchip, it's not coming back out for decades, if ever. It's effectively a permanent reduction in the circulating supply. This industrial demand is a constant, powerful force quietly draining the available physical silver, completely separate from the day-to-day price you see on your screen. Then you have the second wave, speculative and retail demand. When prices move this fast, it creates a sense of urgency. Investors who might have been happy with paper silver, like ETFs or futures contracts, are now rushing to get their hands on the real thing. They want physical delivery. In a normal market, most silver trading is just numbers on a screen. But during these rapid price moves, everyone wants to hold the actual metal, and that completely flips the dynamic, putting even more strain on physical supplies. Retail dealers are feeling the heat from all sides. They're trying to manage this explosion in demand by raising their premiums, which is the amount you pay over the spot price. They're also pushing out delivery times and even setting minimum order sizes. But even with all these measures, they can't keep up with the flood of new buyers. At the exact same time, there's another group in the market, long-term holders. These are people who bought silver years ago when prices were much, much lower. Seeing these new highs, many of them are deciding it's time to sell and take some profits. So dealers are not just dealing with a rush of buyers, they're also managing a huge influx of sellers. Imagine trying to handle massive volumes of both buy and sell orders simultaneously, all while your inventory is disappearing. It's a logistical nightmare. This has created what we call a bifurcated market, or a split market. On one side, you have the industrial sector, operating on its own long-term schedule, mostly unfazed by the short-term price drama. They have their contracts, and they're getting their silver. On the other side, you have retail buyers like us, facing immediate problems: shrinking inventories, rising premiums, and long waits. The stress isn't just in the retail space. We're seeing it at the institutional level too. Take the U.S. Mint, for example. They just executed one of the steepest and fastest repricing actions for their collectible silver eagles that we've seen in modern times. In just 7 days, the price of a proof silver eagle coin jumped from $95 to $173. That's an 82% increase. Uncirculated coins from previous years went from $91 to $169. Normally, an adjustment like this would take about 30 days to implement. They did it in 7. This tells you how quickly the ground is shifting beneath their feet. And even after these massive price hikes, many of these official mint products are still sold out or are being strictly allocated. When the US government itself is signaling scarcity this clearly, you know something significant is happening. What we have now is a classic feedback loop. The supply is tight, the price is rising, the availability is limited. This creates a perception of scarcity. That perception drives even more people to buy, which in turn tightens the supply even further, pushing prices higher still. It's a cycle that feeds on itself. So where does this leave us? The disconnect between the paper price and the ability to get physical metal is becoming more and more pronounced. The industrial demand is a non-negotiable drain on supply that isn't going away. The retail rush is adding fuel to the fire, and government institutions are struggling to keep up. This isn't just a story about numbers on a chart, it's a story about a critical resource, a tangible asset, facing unprecedented demand from all corners of the global economy. The dynamics are shifting faster than ever before, and the implications could be profound. We are witnessing a fundamental repricing of a metal that is essential to both our monetary history and our technological future. Keep a close eye on this situation. The pressures are building, and what happens next in the silver market could be one of the most important financial stories of our time. Thanks for watching, and be sure to subscribe for more updates as this develops. Have you ever looked at the price of silver and wondered what on earth is going on? One day it's up, the next it's down, and sometimes it feels like a roller coaster designed by a madman. Well, you're not wrong to feel that way. But the truth is, the daily price you see on your screen is only one part of a much bigger, much more complex story. Today, we're going to peel back the layers and look at the real forces driving the silver market, because what's happening right now is a game changer. Let's start with the paper market. This is where most of the short-term price action happens. We're talking about futures contracts, options, and other financial instruments that are traded on exchanges. This market is dominated by leverage trading, which means traders are using borrowed money to make huge bets on silver's price direction. Add to that the rise of high-frequency trading and algorithmic execution. These are computer programs designed to buy and sell in fractions of a second, often reacting to tiny price movements. A key part of this system is something called a stop-loss order. A trader sets a price at which their position will automatically be sold to limit their losses. Now, imagine thousands of traders, all using leverage, all setting their stop-loss orders around the same key price levels. What happens when the price dips and hits that level? It triggers a cascade. The first batch of stop-losses becomes sell orders, pushing the price down further, which then triggers the next batch of stop-losses, and so on. It's a domino effect of forced selling, and it can cause massive, gut-wrenching price drops in a matter of minutes or hours. We've seen this happen time and time again. Think back to recent history. On December 29th, silver spiked to around $83 an ounce, only to crash back down by $13 in the very same trading session. That wasn't a change in fundamentals. That was a paper market shakeout. Then, in early January, we saw another vicious correction of over 12%. Mid-January brought another 7% pullback after the price flirted with $93. These weren't random events. If you map them out, you'll see they aligned perfectly with clusters of leveraged positions and those automated stop-loss triggers. The big players, the algorithmic traders, can see where these clusters are, and they know where the pain points are for smaller leveraged traders. For retail investors using margin accounts or leveraged ETFs, these swings can be devastating, leading to margin calls and wiped out accounts. This volatility is a feature, not a bug, of the modern paper market. It's designed to shake out the weak hands. But here's where it gets really interesting. While all this drama is unfolding in the paper markets, there's a completely different reality happening in the physical world. The industrial buyers, the companies that actually need silver to make things like solar panels, electronics, and electric vehicles, are largely unfazed by these daily price swings. They operate on a much longer timeline. They're not speculating on the price for next week. They're securing the physical metal they need for their production lines for the next year. This creates what I call a multi-speed market. First, you have the industrial users, focused on long-term supply and demand fundamentals. They see a world where silver is being consumed at an ever-increasing rate, and they need to lock it down. Second, you have the speculators in the paper market, amplifying short-term volatility and playing their leveraged games. And third, you have the retail dealers, the ones selling coins and bars, who are caught in the middle, trying to manage their inventory and operations amidst all this chaos. This brings us to the most critical distinction of all, the difference between paper exposure and physical ownership. When you own a futures contract, you own a promise. When you hold a leveraged ETF, you own a financial product that tracks the price. Both are subject to the wild swings of the paper market. They can be subject to margin calls, forced liquidations, and the distortions caused by algorithmic trading. But when you hold a physical silver coin or bar in your hand, you own the real thing. It's not subject to a margin call. It can't be forcibly liquidated by a broker. While its dollar price will still fluctuate with the market, your 1 ounce of silver will always be 1 ounce of silver. Its real value is tied to its scarcity and its utility in the physical world. This is a crucial concept to grasp. The ounces you hold are your anchor in a sea of paper volatility, and the physical market is telling a story of growing scarcity. The structural forces are undeniable. A key factor is industrial sequestration. When silver goes into a solar panel or a smartphone, it's essentially gone forever. It's consumed, used up, and removed from the available recyclable supply. This is a permanent drain on the world's silver inventory, and it's happening at an accelerating pace. We see the effects of this tightening supply everywhere. Retail inventories at dealers are shrinking. You'll notice that the premiums you pay over the spot price for coins and bars are rising. This premium is the true cost of getting your hands on the physical metal, and it's a much better indicator of real-world scarcity than the spot price alone. Delivery times are getting longer. It's not always possible to just click buy and have your silver the next day. Dealers are also being forced to change how they operate. Many are imposing higher minimum order sizes to manage their limited inventory. They're putting allocation limits on popular products, meaning you can only buy a certain amount. Even the U.S. Mint, a major sovereign producer, has had to adjust its pricing mechanisms and restrict the availability of its popular silver eagle coins at times. These are not signs of a healthy, well-supplied market. These are signs of stress in the distribution chain. On top of all this, we have the power of psychology. Certain price levels act as massive magnets for attention. The big one, of course, is $100 per ounce. As the price gets closer to these psychological thresholds, it attracts a flood of new speculative interest. This, in turn, can prompt dealers to make even more operational adjustments to prepare for a potential surge in demand, further tightening the market. So, what's the key takeaway from all of this? It's that the spot price you see on the screen no longer tells the whole story. It's just one data point in a much more complex equation. The real state of the silver market is now defined by a combination of factors. You have to look at delivery constraints, the expansion of premiums, the bottlenecks in the supply chain, and the permanent absorption of metal by industry. The silver market is in the middle of a profound structural transition. It's being reshaped by the velocity of paper trading, the danger of leverage, the relentless pull of industrial demand, and the very real stress on the physical distribution network. Understanding how all these overlapping forces interact is absolutely essential if you want to interpret not only the daily volatility, but also the much larger, long-term shift towards undeniable physical scarcity. The game is changing. The relationship between the paper price and the physical metal is becoming more and more disconnected. Paying attention to the signs of physical stress like premiums and availability is now more important than ever. Thanks for watching, and if you found this breakdown helpful, be sure to like, subscribe, and hit that notification bell for more deep dives into the markets. See you next time.